asked to muse on three things, which were the current trends in impact investing, whether COVID has dented the demand for impact investing, and my view of, and I quote, an enlightened post-pandemic economy, which I am going to do, but I'm not going to do them in that order. I actually wanted to reflect first on the title of this conference. By the way, I don't have any slides, so I apologize for everyone. You're just going to have to look at me for about the next 15 minutes. But I wanted to reflect first on the title of the conference. Can impact investing save capitalism? Now, ever since Omar and Chris asked if I would be available to speak at this, I've been asking myself the same question. Rather than can we, should we save capitalism? And if so, what role does impact investing have? Now, for some people, that question is a little bit like asking whether vaping can save the tobacco industry. Now, smarter people than me have tried to answer this question over the last few years, but as an impact investor, I wanted to share with you my thoughts from the front line, so to speak. The first question as humans we nearly always ask ourselves is it broken? And if so, can it be fixed? Rather than why did it break? And did it break because it's fundamentally and functionally the wrong tool for the job in hand? Now, we built a finance system. It's a linear system that deals with tangible assets that are commoditized in the pursuit of profits. It is in many ways a very, very simple system. It's an industrial system though, where assets are real and tradable, but its unintended consequences are all around us at the moment. A system that prioritizes profit by its very nature has sacrifice coded in that results in inequality and inequity. And whilst the system we built has remained largely static over time, the ecosystem we inhabit hasn't. So those inequities and those inequalities have grown. And we now live in an intangible world, not an industrial world, an intangible world, where the inputs and the threats to the system we built are non-linear and they're increasingly molecular and invisible in nature. So those threats, the inputs, are a response largely to the system we've built, but they've always been there. And I remember working at Microsoft in the noughties as their sustainability lead in the UK. We sent out patch after patch to fix what were fundamental design flaws. These were weaknesses in the system that were exploited by those wanting to corrupt the software for gain. And it very much reminds me of where we are now. We've sort of conditioned ourselves to think that patches are acceptable. Well, they're not. Impact investing should not in any way be considered a patch. We need to tackle the fundamental weaknesses in the system, and that's wealth and our definition of it and its purpose. And this is where impact investing helps seed the conditions for sustainable life on Earth. Rather than a patch, it's fundamentally tackling the design weaknesses by offering a recode of the operating system and how we engage with and think about wealth. And I think we need to be really clear here that a reboot of the system simply won't suffice. It's not enough. This is about a system upgrade, hardware and software. And impact investing is not the whole solution, but it's part of it, along with changes to company law as an example, fiduciary responsibility, accounting standards, macroeconomic theory, political reformation, taxation, citizenship engagement. You know, the list is endless, but given how embedded the finance system is in all of these areas, impact investing becomes a very, very powerful source of new code, and one that in a post-pandemic economy seeds the conditions for two things critical in that economy. First, it drives us back into that safe space where we and every other life form can thrive. And second, and really importantly, it keeps us there. Any aspirational coding that does less than that, frankly, is a game of Russian roulette with over 7 billion lives and up to 1 trillion other forms of life. So what is the current situation with impact investing, and what are we witnessing in terms of the trends, the collaborations and the hacks that are happening in the system and that are likely to happen in the future? Well, let's look at the last 8 months and look at whether or not enthusiasm and demand for impact investing has in any way been dented, which was one of the questions I was asked to focus on. No, it hasn't. We've seen some of that from obviously the research that Dean has just presented to us. We've also all probably seen the media coverage of the record inflows of capital into ESG funds and their increased resilience over their non-ESG counterparts in the face of this current global crisis. Global sustainable funds recorded £37 billion worth of inflows over the first quarter of 2020. And the sector completely avoided the COVID-19 market sell-off over the first quarter of this year as well, that saw 384, roughly speaking, about $384 billion withdrawn from the overall fund universe. Now, those are statistics from Morningstar. Europe continued to dominate that specific space, that ESG space. But over the last year, a third of the money flowing into global funds has been committed. Sorry, there's a police car going past right outside my house. Over the last year, a third of the money flowing into global funds has been committed to those focused on ESG investments. But in June and July of this year, so the last 2 months, this proportion has risen to more than half. So it's clear that demand for ESG has ignited, but ESG is not impact investing. Let's be clear. It's better investing, it's risk-adjusted investing, recognizing the broader set of risks that a company faces. It's part of an approach to impact investing, but it is in itself not impact investing. And I think the recent controversies that we've seen, for example, around Boohoo is a good example of the inherent flaws in ESG, given Boohoo was sitting in some ESG funds. However, if we look at ESG as a marker for market sentiment, it's a great bellwether of changes that are afoot. And our own experience as a boutique dedicated impact wealth manager over this last 8-month period is that the demand has certainly not dried up. In fact, quite the opposite. April was our busiest month to date in terms of account opening, and the pace of engagement has been and continues to be, happily, quite relentless. So given we know what's happening with capital flows, and given we know where we need to get to and the type of post-pandemic economy we're looking to achieve, what are we seeing out in the marketplace now that is going to support this seismic shift needed? I've quickly summarized 10 areas that we are very excited about at Tribe. First, and Dean's already alluded to this, is the shift in the accounting practices that are being supported by impact investors requiring better disclosure. The Impact Weighted Accounting Initiative, which Dean has mentioned over at Harvard, and George Seraphim in partnership with the Impact Management Project and the Global Steering Group on Impact Investing, is a really good example of this. And we think this new age in accountancy will drive transparency and disclosure of the liabilities and the externalities associated with those liabilities on balance sheet, and it potentially heralds a new lens through which companies are valued. So we probably all saw, I think it was last week, Apple is now worth $2 trillion. When its natural and human capital liabilities are factored in, I can guarantee you that Apple is not worth $2 trillion. So we need more honest, accurate and transparent reporting of the true cost of running a business and the true value of a business. And this is where impact investing can play a role in demanding these types of disclosures, very much like the conditions that have been set out for disclosure by the TCFD. The second area is the shifts in the interpretation of fiduciary duty. So we've already seen the US Department of Labor announce regressive changes to how pension funds in the US should, or in this case should not, engage with ESG funds. And this has catapulted them into a war of words and wills with some of the big institutional houses in the US, for example, State Street, who've publicly condemned this move, citing fiduciary duty as the reason why ESG matters. So we believe that fiduciary duty is set to take center stage over the next months and the next few years, with impact investors already able to clearly demonstrate that our approach to investing is fiduciary duty in practice. And given that, and given the performance that we're able to generate off that, we hope that others will follow quickly. We also think that there will be the development of more meaningful benchmarks. Again, something that Dean alluded to. It will be a shift from our eternal obsession with growth to benchmarks that better demonstrate how we are seeding the conditions where we thrive. Benchmarks will be used to better understand the true nature of the performance of the business and funds alike. The European Union Technical Expert Group on Sustainable Finance is already leading the charge here in the proposal of low carbon benchmarks, ESG benchmarks, etc., and more will follow. Impact investors, we're already starting to use our own impact benchmarks. So for example, when we report to our clients where we can aggregate and attribute data, and I'll come on to data later, we report benchmarks around temperature pathways in alignment with the Paris Climate Accord, absolute carbon emissions, and gender benchmarks. And those are non-negotiable 3 benchmarks that go out across all of our client portfolios. And clients will continue to demand more as the media focus more and more and more on this, and more comes into the market. I think we'll also see more regulatory pressure for disclosure and standards alongside these benchmarks to try and stem sometimes what seems like the tide of green and rainbow washing. There you are, Graham, there's a couple more terms for you. Green and rainbow washing that is happening. Again, the EU are in a pole position here and are leading the charge, as are the likes of the British Standards Institute and their PAS guidance notes. So thresholds will be set, and in the absence of thresholds, our belief is that the industry itself and society at large will hold offenders to account. Data, and Dean has obviously spent a reasonable amount of time in her presentation talking about some of the challenges with this. Now, data coverage and quality is, and it will continue to improve. Microsoft's recent teaming up with BlackRock is a sign of greater technology engagement with data, and the rise of machine learning and AI as part and parcel of an approach to impact investing. Now, does this mean that the passive investors will rule? No, it won't. Impact investing is too nuanced and too complex at the moment for a true data-driven approach. We only need to look at the impact reporting challenges that are around in the marketplace, and that Dean again has just recently alluded to. You know, we have data paucity, meaning often we have to rely on qualitative information in the absence of quant, and B, we have data manipulation. So we have what sometimes seems like a proliferation of impact calculators reporting supposed impact metrics. Let's be clear, they're not impact, they're output metrics, but that out of context can be meaningless and misleading. And again, as Dean's mentioned, databases like IRIS really help us navigate some of these challenges around impact reporting and help us really focus on the measures that truly articulate the change that is happening, and whether or not this new economic reality that we are all in the process of developing and deploying is driving the change that is required. Citizenship empowerment will continue. So the recent launch here in the UK of the Make My Money Matter campaign, demanding greater disclosure of the pension industry, is a really good example of how consumers are demanding greater transparency from the finance sector. And this is set to continue, and it will only reinforce the approach that impact investors are taking in setting the bar high and reporting transparently. We will all of us on this call will become more engaged with what our wealth is creating and what it is destroying. And we will be demanding far more of those we work with and rely on. ESG will never be enough. It isn't currently, it won't be. And citizens are starting to wake up to this. Transition agreements and the rise of unionization in the pursuit of the protection of workers' rights as we shift this new post-pandemic economy and we focus on a green recovery. Now, this is set to play a really prominent role in the coming months, and it's something that impact investors are acutely aware of, as businesses at risk of structural decline or obsolescence as a result of the shift that's happening will demand just and fair transitions to this new economic paradigm. Workers' rights will be centre stage, not just in transition parlance, but also as part of crisis management, given we know that there are other crises looming on the horizon. Temperature pathways will also become a de facto metric, with more and more clarity as to the warming pathways at business level against the legal backdrop of the Paris Climate Agreement. We are likely to see far more net zero declarations, but we will also see the rise of temperature pathways and targets being set at business level and within the system, within the finance system. The Science Based Targets Initiative is leading the charge here. To date, there are 950 signatories around the world, and they represent about 10% of global GDP. Only 55 of those are finance houses. We're one. We've signed up to the science-based targets. The launch of the finance sector methodology is happening next month in New York as part of Global Climate Week. And we hope and we expect, as a result of that, that the number of finance houses setting science-based targets will rise. The ivory tower is not going to be ivory anymore. With more women in finance coming through and more senior women in finance coming through as well, the conditions are being set for a far more diverse and inclusive finance system, which is what we need in a post-pandemic economy. Where women thrive, we know, as impact investors through the lens of gender lens investing, much like a Trojan horse, broader diversity and inclusion changes occur, including increases in representation of ethnicity, sexuality, age, socioeconomic background, etc. The nature of the human capital in the system is, and it will continue to change. It's inevitable, and it's already happening. Diversity and inclusion will become key drivers in democratizing access to the system and will result in a system more balanced and representative of the society it serves. Now, that's a wholesale shift from the current system that requires society to serve it. And again, as impact investors, we're already here. We're leading the charge, both in terms of how we invest, but also how we govern ourselves. Big call, GDP will be laid to rest. Real measures of a nation's health will emerge. They're already emerging. They will continue to emerge, and they will focus on current and emergent economic theory. So, for example, the great work that Kate Raworth has done through donut economics, which we're actually seeing now being deployed at city level, and the views and the work of Mariana Mazzucato. We will see previously ignored economic inputs being valued. So, for example, the care economy. My call is that other orthodoxies will also be removed or evolved, which will include things like modern portfolio theory and the flawed assumptions it's based on. Dogmas, hopefully, will die, and we won't be replacing them with new dogmas. There will be a wave of creativity that floods the system, and it's happening now. Impact investors are continuing to push the envelope in terms of what new thinking is required. We are never static as an investment community. I think in the immortal words of the late Sir Ken Robinson here in the UK, curiosity is the engine of achievement, and the one thing impact investors are is curious. The stellar rise of mission is going to continue, the global rise of the B Corp movement, the baked-in resilience we all have, Tribe is a B Corp, to market downturns and the shifting consumer sentiment has caught both investor and big business attention alike. It's also caught state attention, which is really, really interesting. So we're seeing a deployment of new company laws, which will be game-changing. You know, the recent shift to an entreprise à mission in France by Danone is testament that leading businesses are really starting to pivot and understand what purpose and mission means for their business. And in the UK, we have Operation Upgrade, again being championed by the B Corp movement, which is establishing a more open and more creative dialogue about company law reformation. And I think finally, the other area that I think is going to become more and more visible as part of a post-pandemic economy, but also as a trend in impact investing, is tax. We're going to see a lot about tax. We've already seen tax being referenced in pandemic bailouts. So we've seen bailout packages in multiple countries around the world being linked to tax avoidance and creative accounting techniques. We currently have a tech tax on the table in the UK, as there are in other countries. We've also seen much more vocal calls for action from a cohort of global wealth holders calling for greater taxation at the top of the wealth spectrum. So tax is going to be one of those next frontiers in impact investing, but also tax is going to take center stage in a post-pandemic economy. So if I get back to kind of my original musing, which was the title of the conference, and Can Impact Investing Save Capitalism? I think the question we probably need to ask ourselves is, can capitalism survive the wave of hacks currently in the system and those coming? Or will it emerge as something new and profoundly different? Certainly if the conversations, I think, happening now that I'm aware of, that I'm involved in, that others on this call will be involved in as well, are anything to go by, there is absolutely no lack of creative thinking and knowledge out there in driving the changes that are required. That being so, it's going to come down to whether we can harness our courage and be prepared to call it wrong in the pursuit of doing what's right. And if we can, then I think it looks like we might be set for a third iteration of an economic paradigm akin to the Renaissance. And yes, impact investing will have played a huge role in that, and it will continue to be a huge part of it.